Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand not only how we're currently positioned, but also what we see out there in the world of investing. You know, there's a lot of talk more about the fiscal cliff, and as I've said many times on my update videos over these last, say, month and a half, 2 months, I firmly believe that it will be dealt with, of course, at the last minute, last hour type scenario, as Congress always does. But ultimately, this has been a wall of worry. I've had numerous phone calls from our radio show listeners about the fiscal cliff worry. What do you think? Are you in cash? That type of stuff. And I said, absolutely not. We're going to follow our strategy. Our strategy is designed to mitigate major risk and actually provide upside income and growth. And the problem with most investment strategies is risk management is not in play. Our risk management is important to our clients, and we'll continue to monitor all the progress, not only of the fiscal cliff, but all the investment markets and sectors out there, so we can better our clients' portfolio, not only for the upside potential, but also to really, again, protect against major catastrophic losses, like in a recession where things go down 20-30%. We are well positioned. We have the vast majority right now, our allocation is, generally speaking, in the emerging market sectors, not only in the income side, but also on some of the equity-based side. And that's obviously held up very, very well in this last month. I firmly believe as we get into 2013 that we will continue our larger exposure to the emerging market areas because relatively they're the strongest asset categories in general that are going on the upside. So we're going to own those. We'll own those as long as they continue to be strong. We'll watch our rankings on an ongoing basis, and we'll make adjustments as necessary. But I think one of the things that investors have to realize is, you know, 2012 is going to end a pretty decent year on the upside, and I think a lot of investors really, at the end of the day, we're scared to really do anything. And what I'm finding, of course, non-clients, because we would not allow this to happen, but what from our radio show listeners is investors loading the boat on bonds and bond funds and bond ETFs. And these investors ultimately, in my opinion, are going to get substantially hurt over the next 2 to 5 years, as I think interest rates have bottomed, and I think ultimately rates will slowly gain steam on the upside. As rates go up, certain types of long-term fixed income assets and mutual funds and bonds and so on will go down. I continue to see people that hire us on a weekly basis that come into our office that are just loaded up on bonds because they want it to be sold what they thought was perceived to be safe, and it's not. And let me explain what I mean. Government treasuries, in essence, are probably the safest investment in the world, at least from default and so on. At least that's what most people's perception is. So if you buy a government bond, it's safe. But government bonds can change in value. And of course, if you look at current interest rates, in just the last 3 weeks alone, long-term government bonds have actually dropped almost 4%. 4% government guaranteed bonds have dropped over the last, let's say, 3 weeks. I'm going to put that in terms of dollars. That means $1 million invested in long-term government bonds would have dropped approximately $40,000. Now, do I think that drop is done? Absolutely not. I think there's going to be more pain to come over the next 2 to 5 years. Not only will those investors not make any real return on interest, because the interest on these things are historically at 40, 50-year lows, but ultimately they're going to lose principal as these interest rates slowly tick up. So you need to look for alternative income areas, and certainly do not reach out into the box for really aggressive fixed income areas. So it's kind of a blend. Ultimately, I believe equity-based investments, not only in the real estate arena, on the publicly traded REIT side, but also on the emerging market side and small mid-cap in the U.S., are probably going to be some of the biggest leaders in the next 2 to 5 years. Simple reason, I think you're going to have merger mania, meaning in the U.S. especially, a lot of corporations have been hoarding cash like crazy for the last 18 to 24 months. I think that money is going to come off the sidelines after the fiscal cliff deal is officially done. Companies will have more certainty, and they're going to start buying small and mid-cap companies to continue to try and grow their business. I think that's going to be a huge boom, not only for the economy long-term, but also for the equity markets on certain sectors of the equity market going into 2013. So if you're loaded up on bonds, if you're not getting proper advice, of course, you can always call our office. If you're a client, rest assured, we're going to do exactly what we need to do, which is grow the principal, garner income for you, and protect against major catastrophic losses. If you're not a client, want to become a client, call our office for a consultation. We always like taking on new clients who are nice people who want to do business. And of course, if you're a client and you have a question about your account or your portfolio, please call our office at any time. We always like talking to our clients. Until Sunday's show, make sure you have yourself a very profitable week.